Hello and welcome to this Forex Preview at XM.com. I'm Maria Pachordiz, and joining me is lead investment analyst Rafi Boyadjian. We'll be discussing upcoming Eurozone inflation data and the potential reaction in the euro. So Rafi, before the current turmoil in the Ukraine, the ECB was moving towards tighter policy. But now policymakers are facing a dilemma given that the war is worsening the energy crisis. What can we expect from Eurozone CPI data due out on Wednesday, and how might it impact ECB policy?
Well, Maria, the Ukraine crisis has certainly created a huge dilemma for the ECB because inflationary pressures in the Eurozone have kind of been brewing for some time. We've seen the inflation rise above 5%, and that trend is set to continue because the flash estimate for February is expected to come in at 5.4%. So that would represent a fresh record high for the data series, and also underlying measures of inflation are also trending higher. They're expected to edge up back towards those near record levels that we saw a few months ago. So overall, we're not seeing any sign that inflation is peaking, and given that the Ukraine turmoil is making this energy crisis even worse, we've seen oil rally really catch a lot of steam since Russia invaded Ukraine. Brent crude is back above $100. Natural gas futures are also up. So we're likely to see inflation head even higher over the coming months. And this would be a huge problem for the ECB because before the crisis, the ECB was arguing that most of the price pressures are down to the energy surge and they would fade over time. So then they don't need to overreact to the inflation surge because it would come down on its own accord. But the longer prices stay higher and the higher prices rise to, so that increases the chance that we would get second round effects. So after a while, and we would see higher inflation become embedded into the economy. So the ECB would definitely have to take a tougher action at some point to curb the inflationary pressures. So this has created a real question mark as to what the ECB is going to do come the March meeting, whether or not they're going to go ahead with their plans to bring forward the timeline of ending their QE program, which was what they were signaling before the war in Ukraine, whether they're going to be able to do that or not, and whether or not are they going to be forced to tighten policy, even if it means choking off the Eurozone recovery.
When the conflict in the Ukraine started, markets pushed the euro lower. What should traders look out for?
Well, we might not really get any clear signals as to what the ECB will do from the inflation data. Of course, if we get a positive surprise in inflation numbers, that could help the euro. I guess that could provide a bit of a support for the euro, given that it's still being weighed by the Ukraine crisis at the moment. We've seen the euro steadying just a little bit over the past day or two, but overall the risks in the near term for the euro are to the downside because should we see this war being dragged out over a period of time and energy prices continue to rise, then investors are going to worry even more about the Eurozone economy. But that's what this dilemma is about. How will the ECB be able to strike a balance in terms of keeping a lid on inflation and at the same time not to hurt the economy? So it is possible that the euro might start to recover either as the crisis de-escalates, or if the ECB is forced to, one way or another, tighten policy much quicker than expected. Otherwise, the euro will remain skewed to the downside.
Rafi, thanks so much. And thanks for joining us at XM.com.